This morning, we've got our oil and gas expert and our editor-at-large, John Kingston, with us this morning. John, thank you for joining us.
So I'm the first guest ever on the revised Freightwaves Now.
The first guest ever on the revised Freightwaves Now, and it's great to have you. The story is pretty big when we're talking about what's going on in the diesel markets right now.
Yeah, I mean, how many different ways we can look at it? I will tell you that the number that I think I've been looking at, a lot of people have been looking at, has been the East Coast because the inventories down there are at kind of lowest, depending how you measure it, maybe the lowest levels ever. They're just astounding in how low they are, and the spread between and the retail market between, let's say, the rest of the country and the East Coast is out to about 20 cents or so. That's usually like not much of a spread at all. So the number that I've been looking at has been the spot market number. That's the material that's traded among physical traders. The spread between the Gulf Coast diesel price and the East Coast diesel price. Again, this is not retail. This is the spot market, the traders where they play. That spread is usually a few cents. That's it. It blew out early last week, to about 60 cents. I mean, this is astounding. I mean, truly, truly astounding. It then dropped on Wednesday and Thursday back to around 30 to 35 cents, which really gave me some comfort in that maybe the squeeze on the East Coast had, for whatever reason, seen maybe a few signs of ending. And then on Friday, it blew back out to the 60, 65 cent level, which kind of knocked out that idea. So that is, to me, the number that is the most important one right now, because the East Coast is the one that's most important run right now. The rest of the country will pay a lot for diesel, but I think at this point we feel pretty confident that they'll get diesel. The concern on the East Coast has been, will you even get it? And so that number is the one that we are looking at the most closely. Now, there was a stir last week, I guess it was last Wednesday, when Bloomberg interviewed a man named John Castimedes. John Castimedes is involved in many, many things. He ran for mayor of New York, among other things. But he owns a small refinery and fuel distribution business called United Refining. And he's just very open with the press, and he's always been kind of a great quote. And he told Bloomberg that he could imagine that diesel would be allocated by the summer. Well, I mean, the summer is like a month away. I don't know when you consider the summer starting. But that created a great deal of stir, as it should have. I mean, it would be a very big story if, in fact, we had to allocate diesel. Right now, there are no signs of allocations going into place. But if we do, that's going to be really, really ugly. What happens under allocations is that the term customers, like the big shippers, or not so much the big shippers, but the big carriers, they'd have a contract with a major supplier like a Love's, and they might say, well, you're only going to get 90% of your contracted supply. That's bad for Love's, where it's really bad for the independent owner-operators who have no contract, because their supplies could drop to zero. So it's a pretty scary scenario that is not yet in place, but we are watching for it.
And John, when we're looking at this situation, of course, it's something that could get a lot worse as we continue to move into the summer months, as you mentioned. Are there any fixes out there? Are there any potential solutions, or do we just have to wait this out?
Well, you in something like this, there's no one big fix. So you look for little signs that might show that things are getting better. So I will tell you that, I mean, I pointed earlier to the East Coast spread. I thought that was a sign that was getting better, and then that blew back out. I will tell you that the diesel contract on the CME Commodity Exchange, which is an East Coast delivered price, so it is somewhat indicative, has been trailing the increases in the prices of crude and gasoline. Gasoline's been crazy. Increases in the price of crude and gasoline for most of last week. Again, a small sign. I will tell you that the numbers right now do not work on exporting diesel off the East Coast or even the Gulf Coast to Europe. You're much better off sending it to the East Coast. So again, the exports have been high, and I think that's certainly a reason why the East Coast is so tight. Right now, the math doesn't work on the exports, so that could have that decline. There is a market for something called space on the Colonial Pipeline. Let's say I had a contract to move material on the Colonial Pipeline, which runs from the Gulf Coast all the way up to the New York Harbor. If I didn't need that space, I could sell it to somebody else. Somebody I know told me last week that the market for selling space on Colonial had strengthened, which is a suggestion that there's more material to move of Colonial. So again, you look for these little things that kind of point to where things might be going. There's not one big fix. The other thing is that we're coming out of maintenance season for the refining sector. The refining margins are just off the charts right now. They're so strong. And so you hope that the refineries will ramp up even more. I will tell you that the increase in the price of gasoline in the commodity markets is somewhat discouraging for diesel consumers, because that means that the incentive then becomes more to make gasoline and maybe a little less diesel. So again, you look for these little things. There's no one big fix. These are the data points that I've been looking at.
And so, John, then moving forward into our busy summer months, we're talking about busy summer travel. We're talking about freight kind of picking up as we get into kind of the peak of produce season. What does this mean for the broader state of freight as a whole right now? Are we looking at now this starting to drive up rates a little bit more and maybe pulling us out of that rate slide that we've seen?
Well, I would think it has to pull up rates, because yes, it's easy to look at somebody like a Knight Swift, and they're probably almost every piece of cargo piece of freight that they're moving is being done on a fuel surcharge, so that gets paid by the shipper. If you're an independent owner operator, the model is that you have to book a rate that's good enough to be able to cover your costs, including the fuel. So if you cannot get that rate that covers fuel, you're going to park your truck, and at that point, that's less capacity, that drives up rates. So these things do tend to balance out, but as I said before, they balance out through demand destruction, and demand destruction is very, very painful.
And John, I think we can keep going on this topic for a lot of time here, just because there's so much to unpack. Can you talk to us a little bit about the rider situation and what's going on over there?
Yeah, well, first of all, I thought that these people knew that you're not supposed to make big news on a Friday. I mean, this is just against the law. So a company called, and wait, I've got to get their name here. Excuse me. A company called, because I'd never heard of them before, HG Vora Capital, on Friday filed a 13D form with the Securities and Exchange Commission saying that it had launched a tender offer. I don't know if they actually launched the offer, but that it was planning on making a tender offer to acquire all of Ryder for a share, I think $84.50 a share. Now, they had already acquired, I guess, a while back, a little under 5% of the company. So they had not, if you're under 5%, you don't have to file with the SEC. So in their filing that they made on Friday, they said that they owned, I think, 9 point something percent, and that they intended to acquire the whole company. Now, from the little bit I can tell about HG Vora, buying whole companies is not what they do. They're more of an activist investor. And speaking to a couple of analysts, I think what they're probably trying to do is they may look for a breakup of the company. So everybody knows about Ryder's leasing of trucks, right? You see those all over the place. That's about a little over 50% of the company. They also have a division called Dedicated, which does exactly what Dedicated does for truckload carriers. They take over the trucking activities, the transportation activities of specific customers. The third one, which seems to be the one that's most interesting here, is CSS, Supply Chain Solutions. And it is what we call a contract logistics company. It comes in and basically runs your logistics. There was a report out by a company called Vertical Advisors. It didn't come out all that long ago, like last month before all this happened, in which they said that, Ryder's stock was trading, $70, $75 a share before this offer, but they felt that the breakup value of the company was closer to $150. And they said one of the reasons for that they came to that conclusion is that you finally be able to get a good valuation on what SCS is because of the existence of GXO. So GXO is a contract logistics firm. It was spun off of XPO, and as a result, it is a pure play contract logistics firm. And GXO said at the time, we're the only ones like this. So the problem for Ryder really is that now you have a point of comparison. What is our SCS company worth? Well, how does it compare to others? Before GXO, you really didn't know what it compared to. Okay, now you have GXO, so you can make that comparison. And so it would not surprise me that what's going to happen here is that HG Vora is going to probably acquire some more stock, and they're going to sit down with Ryder, and they're going to say, you really need to reorganize this company. And it is possible that it may split into two. They may sell off the SCS under the idea that it is being very undervalued now by the stock market. If the sum of the parts is 150, as Vertical Capital Advisors said last month, and you're trading at 884, and you only got there because of this acquisition offer, now you got a real problem here. So it's possible that they could that they could sell off the SCS group. Maybe they sell off their dedicated transportation unit. There aren't a lot of synergies there. You know, the leasing, the truck and equipment leasing business, the SCS and the dedicated, yeah, they're all transportation, they're all logistics, but they're not really in the same field. And Wall Street does not like confusing plays. It likes pure plays. And Ryder isn't.
Absolutely, and I think we saw that at the Future of Supply Chain as they had both demos from RyderShare, they had Coop by Ryder there, and they had kind of this fragmented representation almost, as I would call it, there at the conference.
Yeah, good point. I mean, you saw it straight up there.
Yeah. Looking forward to this next week, what are you going to be keeping your eye on as far as stories go?
Well, I think I'll keep my eye on diesel. I think that's going to be...
All right, I think we briefly lost John Kingston. We'll try to get him back a little bit later on in the show, but right now we're going to toss over to the woman with many talents, Kaylee Nix, with our look at today's weather.